So do you think increasing the number of mutual fund distributors without a regulation or check will also contribute to mis-selling in mutual funds in India going forward?
Anybody who's selling has to be certain.
Still, why do you think that the active space would be better for the investors at the end?
It's a good question. It's a very relevant question to ask.
Which sectors do you think are going to maybe outperform in the next 3 years? Are you betting on them?
Clearly, two things came out. Healthcare was.
Kartik Jain is the Managing Director and CEO of Shriram Asset Management Company. He is an IIT Bombay graduate and IIM Calcutta pass out with over 30 years of experience across brands like Cadbury, HDFC Bank and DBS. Today, he joins us to share how he's using innovation and strategic investments to revive a 30-year-old AMC.
Hi Kartik, welcome to our show. Thanks for accepting the invite. So, how are you doing?
Very well, and thanks for having me here. Really appreciate the chance to have a interaction and with you, and of course, reach out to your audience as well.
Great. So, how has your been experience in the last 2 years as the CEO of Shriram AMC?
Oh, pretty good. It's quite an interesting space to be in. As you all know, that asset management is quite a challenging space as well as a high potential. And given where the Indian markets are and where the investor mindset and mind frame is, it's a significant, huge opportunity and huge potential, for someone to come in and create a very unique and differentiated, product offerings and grow the franchise. And yeah, never a dull moment.
Great. So the company has been in existence and even listed on the bourses for more than 30 years now, right? And the AUM until Jan 23, that is when you joined, was just around 300 crores. Now it has surpassed as of December to 1,000 crores. What did you change in these last 2 years that made a tectonic shift in the company's plans to take this business seriously? The group's plan basically to take this business seriously.
So fundamentally, the shift that happened was we had a new investor who came in, a US-based investor, Mission One Investments. They came in and the idea was to, in a way, resurrect the business, rejuvenate it, and tap into the opportunity in the growing, capital market space in India. When I joined, the whole idea was, okay, let's start to rebuild our presence, and we called it Shriram AMC 2.0. We went back to the market with a refreshed kind of positioning. So I worked on 3 core pillars, which are called the 3 Ps. This performance, product, and placement or distribution. And of course, the 4th is people, the right kind of people you hire with the right mindset, right? So the idea was, since we are, like you said, we are quite small initially, how do we go and differentiate ourselves in the market? So we worked on the first P, on the performance side. We went to the market with a very differentiated investment framework called the Quantal Approach. But we felt that given that the post-COVID regime was characterized with higher interest rates, more uncertainty, more volatility, it made sense to have a kind of a quant element in the investment philosophy. Not just fundamental buy and hold, but have a quant. But the difference was we did quant plus fundamental, quantamental. So we have the machine giving the factor-based portfolio creation, but the final portfolio went out, risk-adjusted portfolio there was a fundamental overlay by the analyst and the fund manager. So it's quant plus fundamental, quantamental, machine plus man, giving you what we called, our own brand of AI or artificial intelligence, but alpha intelligence, right? So how do we create an approach that gives us alpha over time, over the benchmark? That's the first P. And when we went to market, we found a lot of acceptance on the approach and our factor-based models, the back-tested outcomes, very clear strategies, and so on. And we deployed that model now the last 1.5 years with reasonably good results across over time. And the second was the P. So we said, look, how do we do 2 things? One is have the right range of product portfolio to meet customers' typical requirements across the risk-return spectrum, short-term needs, medium-term needs, and long-term needs, right? So whether it's debt products or hybrid products for medium-term or for long-term or equity products, right? So over the last 2 years, we've added to our portfolio, launched 2 equity and 2 debt products. We have 9 products now, 3 in debt, 3 in hybrid, and 3 in equity, including things like flexi cap. We've got the multi-asset allocation funds, the balanced advantage, aggressive hybrid, and so on and so forth. And we have the liquid funds and the overnight funds and so on. So that's the second thing we did. And also in the process, we also tried to make sure that we launched differentiated products. So last recent NFO, about a month back, was the Shriram Multi-Sector Rotation Fund, the first of its kind on the sector rotation theme in the country, which essentially helps investors avoid sector traps and ride sector trends. A very good reception, good feedback, and quite a unique product in the market that met a specific customer need or pain point. On the third aspect, the placement, we looked at two aspects. Of course, because Shriram Group is fairly well established, pan-India presence. The group has, we saw both, so therefore both the group-based channels and the external channels. And from the group perspective, about 4,500 branches, 3 crore customers, 1.5 lakh agents, and 1 point, over 1 lakh employees. A fairly wide footprint, right? So the whole idea was how do you work with them to tap into those channels, and that work is on right now. And we're working closely with the different, registered group distribution entities to take mutual funds to their customers. For example, Shriram Finance, which is the flagship company, has taken a ARN for mutual fund distribution. And now mutual fund is there in the super app, the Shriram One app, which has all the group products in one place, right? That got launched in November. So intent is to embed our offerings within their portfolio of solutions. On the external side, we're building a team up, ensuring that we're there in the top 15, top 30 markets and reaching out to the various advisor distributors in a very structured way, reaching out to at the top end, the wealth managers, the banks, then the national distributors, as well as the large distributors, large individual advisors, and then and even the mass ones, and reaching out to them in a very structured way to make sure we present our offerings to them. So that we found has really helped us, and really build up our both presence, visibility, to be seen as a differentiated player who's here with a difference, and obviously with the backing of the Shriram Trust and the Shriram brand, we're able to therefore grow our AUMs. And the fourth P, if you will, is the people part. We try to make sure we get people on board who have a growth mindset, who understand that while it's a very strong brand behind us, but we're also in a startup mode in many ways. So you have to really roll up your sleeves, and be innovative, be different, and to scale up, right? So that's the thing we've been doing.
I won't name any AMC, really, but there have been some AMCs which have been trying such models, and while their 1 to 2 to 3 year performance was very good, but if we looked at their subsequent years' performance, were trying to build through quant models, they dipped very sharply after a point of time. So how do you plan on managing the mistakes that they did, which you won't do at Shriram AMC?
The key thing is to look at what is the quantamental, also framework and approach and your philosophy. So what we do, the advantage of a quantamental approach is that I can backtest my strategies.
Okay.
That's one, right? So we have a 10-year, 20-year backtest. So I know that how the model it'll perform in different cycles, right? So, and we run the model parallelly with the live fund. So we keep calibrating and checking and tracking how's the model behaving in different environments, and how does with our fundamental overlay, how am I able to add an alpha overlay to what the model is recommending, right? So that learning keeps adding on.
Okay.
So one is that if someone needs to ask me why am I underperforming, overperforming, we have a very clear understanding of why it's behaving the way it is, and also when will it, let's say, recover or change its trajectory. The second most important thing is that because the core, the database models, right? The environment keeps evolving. So it's very important that you keep on evolving your models as well. So while we have a specific model in place, we don't stay still. We keep on reviewing and trying to find ways to enhance our underlying algorithm.
Okay.
And that's an ongoing process. And then we keep testing it again to see how it's adapting to changing environments. So the idea is that you keep your view on the rear view mirror. At the same time, you're also looking ahead and managing the road ahead with agility.
Got it. So what all technology is used, and what all data points, if you can name a few, for your proprietary models to build an asset strategy on?
So we use Python,
Okay.
and we have a full-fledged quant team who works on that. We also have the analysts and fund managers. So we use the various platforms. The database is the normal market data that's available to everybody. The question is, how do you use it?
Okay.
Right? So how do you clean the data? How do you utilize it? How do you take it as an input into your models? The other aspect is, how do you look at maybe non-traditional data, or maybe subjective data points to build early alpha signals, alpha triggers. That's ongoing work. So how can we use various maybe AI tools to identify what are the upcoming trends?
Can you share an example if possible?
Still working on it. But
Okay.
typically it's linked to how does a corporate action maybe convert to an alpha trigger,
Okay.
right? So that's the thinking. So
Corporate action in one particular company. Not,
yeah,
okay.
in a company.
So talking about non-traditional data points, do you also look at data around how weather conditions have impacted crop producers and cost of the companies in the past?
That's potential. It's a potential use case. Now we aren't there as yet,
Okay.
but in the long term again, there's a potential. So the key, like you said, is how do you convert that data into and link it, correlate to actual outcomes, and be able to backtest it.
Got
Yeah.
it.
So long way to go, but that's the journey we are looking at.
Great, interesting. So coming back to the AUM question, like we discussed, in 2 years it has increased from 300 to 1,000 crores.
Right.
How can you, attribute it to NFOs, primary investments done by new investors or the existing ones, and third, to asset growth?
Yeah, so of the jump that we've had, about I think 400 crores through the NFOs, about 125, 150 through the net flows after that, and rest to the mark-to-market impact. The markets also have been pretty supportive, at least till recently. Yeah.
Right. So how much percentage of your AUM today is in equity mutual funds and the rest in debt liquid?
About
mutual
2/3,
funds?
1/3 right now.
Okay, got it.
And on the product side, we have also launched our PMS recently in December itself. So if it's equity, debt, and the PMS, we have a range of products that meet various customer segments needs. Right from I can go and service from the smallest borrower within Shriram Finance, as well as the ultra HNI customers for Shriram Wealth, as well as offered to the corporates. Right. So we're covering all the various segments of the customers that typically would be interacting with the Shriram brand.
Where do you see this AUM growth growing from today, 2,000 crores to maybe say by the end of fiscal 26? And what measures are you going to take for that?
Yeah, I can't make any clear forward-looking statements. Right. But the intent is how do you maintain the growth rate, right?
Right.
And how do you, because base is small right now and we are growing, right? Investing.
Right.
So the idea is how do you maintain the growth rate? And that's one. In terms of how to get there, like I said, we're very clear in our thinking. The 3 pillars to us are clear, 3+1, performance, product, placement, plus people. And how do we get that even stronger? So I'll just touch about each of these 3. I already explained to you what they mean, how we're looking at these 3. But in performance, like I said, how do you keep on enhancing our factor models? And that work is ongoing. For instance, with the multi-sector rotation fund, we ran a double quant engine. We tested 180 models to see what's the right final optimal model for the fund finally. For the PMS, we have a dynamic weight factor model that we're running to minimize the churn, because the PMS is a tax implication, right? So we're constantly enhancing and improving our quant abilities to better be able to build more better and better strategies. So that is one of the performance. We continue doing that. Like I said, keep testing out. Even can we look at more other non-traditional data in the coming future. On the product side, again, continue our view on how do you have more innovative, differentiated products. We're looking at all the options. I'm not saying anything is close to us, but in PMS, can we have more differentiated strategies? Can we look at smart beta strategies and so on? So that's ongoing. And on the placement side, the digital side, we are also stepping up. And as our volumes are growing, AUMs are growing, we also have a higher investor education and awareness budget to deploy. So that also is seeing how do we smartly deploy it through digital channels to reach out to customers, make them aware of the quantum metal philosophy, the multi-sector kind of sector rotation kind of strategies, and so on and so forth, SIPs and so on. And people hiring continues. We want to make sure we are there in the top T30 markets with a good strong presence, and being able to also serve our distributors in a far more better way, digitally and more seamlessly, and so on. So we believe that these are core building blocks, if you will, of the asset management business. And we get these right, that's building a very strong, sustainable foundation for future growth.
Still, if you have to give a guidance, then where do you see it going?
Maintain the growth rate.
The growth, 3x in 2 years.
Whatever that turns out to be.
Great. So, you see, the company was listed 30 years back, and until 2023, when you joined, the AUM was just 300 crores. Like typically, when you see the new age broking companies launching their AMCs, they have blitzscaled their AUMs within a matter of a few months.
Right.
Then why was the group not so serious about, of course, listing a company and running an AMC comes with a fixed cost, right? And
True.
That was ongoing, right? Mm-hmm. Then why did the group not focus so much on this particular side of business while the other businesses are doing really well?
See, after launching the AMC business, what the group realized was that their customer base, a traditional Shriram customer base, is more used to the fixed returns of, let's say, chits or fixed deposits, right? And they were not very comfortable or used to the volatility of equities, right? Especially after the 2000, the markets crashed, or GFC, etc., right? So there was some cautiousness from the group's part that should we scale up the business beyond a point, because the customer base is not the ones who are typically used to this kind of a volatility in terms of returns. What's happened now is that the market has changed. So two things have happened. One is the market is more mature. Thanks to mutual fund Sahi Hai, the AMFI campaign, people understand the pros and cons of mutual funds and how SIPs can be a good strategy to stay in the market, invest in the market. Second is that if you see from the group's customer profile perspective, the people who are investing, right? So the fixed deposit ticket size maybe has gone up, say, from 5,000-10,000 rupees ticket size many years ago to 5-6 lakhs on the average now, right? So the customers also have wealth, and like our patriarch founder says that, look, we've helped the truck driver become a fleet owner. It's now time to also help them manage the wealth. So linked to that, why the group has continued with this business is that we felt, look, eventually we are and want to be in the varied financial services verticals. We are lending, we are now in general insurance, life insurance. We also have broking entities. So it made sense to retain the license for an asset management company as well. So in that sense, there was more in maintenance mode. We retained it, didn't exit the business, kept it, and then in a way, kind of waiting till the time would be right. I think right now the time is right because India has now realized, the opportunity in the wealth space. By wealth, I mean asset management, broking, wealth management, and so on. So that's the space where we are in right now.
So you're planning to raise 105 crores from Sanlam, which is a South African financial services group. What made you raise that money? That is point number one. And how are your plans to deploy that?
So essentially, capital raises, from our perspective, we are growing, right? Essentially, it's growth capital. And if you look at the objects of the issue you've spoken about, essentially for expansion plans and working capital to build the business out. You might say, okay, why Sanlam, right? So Sanlam, not many might know fully, but Sanlam is a strategic partner for Shriram Group as a whole. Okay. There's a 40% stake in Shriram Capital. They already are a joint venture partner for Shriram Life and Shriram General. And now with this, preferential issue, they'll also become a stakeholder with Shriram Asset Management. In that sense, therefore, they're completely linked with all the Shriram Group's verticals. And Sanlam is also one of the largest insurers and largest asset managers in South Africa. So they bring with them a lot of expertise and knowledge, which will also help us tremendously as we grow the business and build credibility as well. So for external, let's say even the investors, to have a overseas partner come in and take a stake in the business, they've seen the last 2 years what we've done. They've obviously appreciated that, and they've also got the confidence to invest in us. And we're a listed company, right? So it's a positive, to my mind, as a signal to the market as well.
The group in itself is very well funded. Then why not the group internally decided to fund to grow this business ever since the beginning and right now especially as well? Then having, of course, while it's a JV partner in other businesses, why not the group decided to double down and instead have an external, albeit a JV partner for funding this business?
See, group has always been investing in the business to keep it running.
Okay.
And as the net worth norms have changed to 50 crores now, much lower earlier, the group has funded the business to make sure that we are in the game, right? Sanlam coming in is a strategic investment. It's not just saying, look, even the group could have invested if they wanted to, right? But bringing Sanlam in is actually getting the partner into the business and actually helping us grow. It's not a financial investment only. It's strategic in nature because obviously benefit from the learning and expertise of the Sanlam team as well.
How challenging is active fund management in India, especially considering that most of the mutual fund AUM, equity AUM, goes to the top 100 companies by market capitalization. It's more than 60% now. So what all challenges do you face when it comes to companies beyond the top 100, the ones which are beneath the top 100, especially in terms of liquidity, price discovery, because you are institutional investors. You are not going to buy 5,000 shares, 10,000 shares. So you're going to buy shares in lakhs of quantity or even maybe in millions or crores of quantity. So how do you navigate through that challenge in active fund management?
So while the number of shares, like you said, are about 4,000 listed shares, stocks, we require data in adequate measure for our quant and factor models. So therefore, typically focus on the top Nifty 500 stocks only. There you have good data available, or going back to historical data, so we can run our back testing as well. And you have also clean data available, because we'll track the entire historical corporate actions and so on and so forth as well. So that's one point I would like to bring to you. That's our universe of operation, if you will. From our perspective, we decided to be an active fund house because we felt that that is the way, given where India is, the opportunity is a growth market, right? If you look at developed markets where the growth may not be as high, the opportunity for active funds to deliver alpha is quite difficult and tough, right?
Yeah.
From our perspective, the opportunity is there, right? So we felt the quantamental approach, active fund management with the data-based approach, the algorithmic approach, actually is suited to the current phase that India is going through. So that's where we are. So in that sense, yeah, I mean, we think that we're in the right approach, So I think you asked a couple of questions, right? To your first one in terms of liquidity and how do you manage it, top 500 stocks, that helps us, fairly liquid, data available, works with our model. And how do you manage active? We've got our quantamental approach, a factor model. It's optimized to look at the positive hit rate, which delivers alpha over time. And that's our approach. And we believe that's what the market would also look for. And also the investors, if you see, while yes, they have the options to invest in passives as well. That's a growing segment. But they also want to get the upside that the market offers. So therefore, my understanding is that we have to be in that space at this stage for, customer, what the investors also expect and where the opportunity is.
Currently, the passive AUM, since you're speaking of passive, I'll speak about this as well. Currently, the passive AUM has grown multifold, especially thanks to the EPFO inflows as a percentage of the total AUM, which is close to 17% now in India. While if we talk about US, it hovers between 25 to 35%. Right now, it's around 30%, right? Do you see this proportion going forward grow in India as well?
Yeah, so passive, I think, given what I spoke about in the US context, right, because it's more difficult for active fund managers to deliver alpha, and they found that it's better off to invest in passives itself, right? In the Indian context, I guess passives will grow, but albeit I think at a slower rate. In fact, if I know the data correctly, last 1 year, equities has grown more than the passives because the demand is still equity-led market right now in the Indian context. So both have their space in the sun, and I think the active story isn't over as yet. It'll take some time for it to play out fully. Currently, the passives, a lot of it is still driven by institutional investors, right? So there'll be the institutions like corporates putting money in the index ETFs, or whether it be the pension funds and so on. Retail participation is still a bit lower in that sense.
Okay. So speaking of active versus passive, if I talk about the SPIVA report that got recently published, more than 50% of large cap funds have been underperforming their underlying, right? Across all time frames. I'm not just talking about 1, 2, 5, 10 years. I'm talking about all of them. Even if we talk about small and mid caps, so mid caps is beyond top 100 and then small caps are beyond 250 in terms of market cap. Even they have got similar trends, of course, a little bit lower than large caps, but still 40 to 60% of them have been underperforming their actively managed, they're basically the benchmarks, right? Then still, why do you think that, not particularly you, but in the industry as a whole, the active space would become better, would be better for the investors at the end, because I have 1 in 2 chance of losing more money than investing in a passive fund, maybe by a few basis points, but definitely so.
The upside certainly can be higher for an active fund, definitely. The question you're asking is how consistently can the active fund outperform the benchmark, right?
Right.
So it's a good question. It's a very relevant question to ask. And so if it's a fundamentally managed fund, a lot depends on their entire, the skill of the fund manager and the experience of the fund manager and the quality of the research, right? And very often, that's what makes a difference, right, from the fundamental aspect. What also happens is the markets keep evolving and changing. Why would the fund underperform at a particular point in time, right, or outperform sometimes? So the markets keep changing. The question is, are you able to adapt your strategy if the regime changes? We believe that, so I'm not defending or, let's say, deriding any specific fund or fund house or fund manager. All of us are in the similar boat, if you will. All have trying to be active and create consistent alpha over time. That's the intent. From our perspective, the quantamental model approach, we believe, and we've seen the backtest data, right? We believe in the longer run, it will consistently, what we've seen as data at least, consistently give us better returns than the benchmark. There would be up cycles and down cycles, the periods of out and underperformance, but because equity we believe is a long-term perspective, we believe that, and we can see and the beauty is that I can test my strategies historically and across cycles, right? So the probability of getting alpha is that sense I think is higher because the machine in a way removes biases, right? It looks at data. So the more stronger you build your algorithm, it's unbiased, looks at data, gives you a very clear output. And that then also drives more efficiency. If I had to, for example, if I have to have, say, a multi-sector fund, right? Multi-sector rotation fund, we're looking at 19 sectors every month and 500 stocks. If I had to analyze every sector and predict which one will do well in the next month, or look at all the stocks within the sectors, I'll require a larger team of analysts. But here what happens is my machine does the analysis for me, and then I only evaluate the output, which is 5 or 6 sectors and probably 40, 50 stocks. So it increases efficiencies. And third, like I said, I can backtest it. So 3 things that the quantamental approach does to kind of increase probability of an active fund to give alpha over time. One is it removes biases. Second, it can consume large amounts of data and therefore be more efficient and more effective. And third, like I said, because it can be backtested, you can kind of predict how it will behave over time. So your predictability also kind of increases. So that's the intent. Of course, finally, it's the how the markets behave and how we adapt to the markets.
So as per your models, the quantamental approach, which sectors do you think are going to maybe outperform in the next 3 years, and are you betting on them?
So I can talk about what the model is talking about, right, and what we've published.
Right.
So our fund fact sheet for December, clearly 2 things came out. Healthcare has been on the top for quite some time now, and that continues to be so. And we also spoke about a consumption theme that we're seeing coming out, which was people, consumer durables, FMCG, and consumer services. These 2 kind of trends we saw in the last analysis we did.
Okay.
Of course, now as we said, the model as the markets evolve, as environment changes, we'll keep checking which at different points in time, different sectors do come on top.
Right.
Can't predict that. It depends on how But of course, if you look at what's happening this year, we expect that government capex would increase. So therefore, so would private capex over time. So would private consumption. So from an overall perspective, infra capital goods should do well. But let's see how it pans out.
Great. So speaking of a 10-year horizon, do you see any sunrise sectors?
So traditional ones, of course, the renewables everyone knows about. Even the EV, of course, is a clear space that is being invested in. Yeah, I mean, these are well known to everybody.
EV was a market darling if we talk about 2 to 3 years back, but
right. And that drove the
but now people are realizing, even the stock pickers and all, that it was maybe too early for them and too bullish for them to double down on EV, because India is not infrastructure ready for EVs, and the prices are also way higher. And India is a market where you have to justify each and every penny before you are going to the market, right? And the customer is very price sensitive. Like they're value driven. I won't say they are price conscious, they're value conscious, right? So now these stocks which were betting too heavily on EVs have also gotten a beating. Right. So still you believe, like in the next 10 years forward, we'll see an EV boom? Like are we seeing any positive trends in terms of the infrastructure that's building around EVs?
I mean, I'm saying more in terms of, you mentioned like the long term, right? So long term, what do you think could be spaces that could come out? There's renewables, there is the EV space, there is potentially data centers, investments in AI. We can see those trends emerging, right? So
we have seen a very sporadic increase in thematic and sectoral funds in the market, right? So given that, how do you think your fund, that is the SMURF, will be able to get not just inflows but also perform better in the coming months to go forward?
So you have to understand what is the thesis behind the Shriram multi-sector rotation fund. What we found out was that sectors and themes go through cycles, right? And investors find it difficult to time the entry or exit. As a result, high probability of getting caught in a sector trap. If you enter it too late, and then typically the cycle could take a couple of years to turn around, right? You're stuck for a couple of years, right? So the feedback, in fact, the idea came to us from our distributors and our partners, right? Advisors. They said, look, many of them actually had stopped recommending sectoral funds. So this same reason, because investors came back to them, look, I have invested in ABC, did well initially, now I'm stuck, I couldn't exit, right? So they said, look, why don't you do the rotation? What if the AMC could do using the research and analysis, identify the trending sectors, and we could rotate across the sectors. We did the entire research. We analyzed the data, took us like a year to build those, test the about 180 models and see which is the best one that could capture that. And finally, what we've got as a solution, what we found is that if you pick the top 5 or 6 trending sectors at a point in time and build a portfolio around that, the probability of outperformance is much higher. And what we do is, so you have multiple sectors, 5 or 6, you diversify the risk. At the same time, you're rotating. So we identify those sectors based on our quant models that are, let's say, underperforming, and we replace them with the next upcoming sector. So we actually completely churn the sector entirely. So what the investor gets is actually at any point in time an exposure to what we think are the performing sectors. And in that we take the performing stocks as well. So, and the back test data shows us that this model kind of works. Yes, it's a bit volatile because we are moving sectors in and out sometimes. Although we do find that sectors remain on the top 5 or 6 from at least 3 months to could be even a couple of years or more, right? So some have stability, but some could be moving out. So it is a bit volatile, but we find in the long run, the strategy is actually helping us get pretty good returns versus the conventional strategies.
Got it. Now coming off, speaking of insurance agents and mutual fund distributors, do you think that a very large base of insurance distributors, which are more than 2.5 million now in India, is contributing to mis-selling practices because they are unqualified? Of course, we don't have these many qualified people in India to sell financial products. So do you think that is a reason of mis-selling in India of insurance products vis-a-vis mutual funds, and increasing the number of mutual fund distributors without a regulation or check will also contribute to mis-selling in mutual funds in India going forward?
See, I can't comment on the life insurance space per se, but I do know that anybody who's selling has to be certified, right, and trained. They have to go through the entire IRDA training program as well and get certified. Secondly, there's very strict checks and balances, including customer callbacks. That's part of the process and regulation where to ensure that the product has not been missold. So there are checks and balances in the system to make sure that there's no mis-selling. And compared to mutual funds, insurance is slightly more complex products. So in the mutual fund scenario, while yes, in insurance, given the nature of the product, there are higher commissions. But in mutual funds, it's lesser commissions in that sense. They're simpler products. Customers are far more evolved and aware. And there's transparency in the fund performance. Very easily you can find out how the funds are doing across time. Also transparency in terms of the expense ratios and the commissions going to distributors, right? So, and all the aggregators help you compare funds very, very easily, across categories, across time, and so on and so forth. So we believe that lesser likelihood of mis-selling, given the kind of awareness that people have now. And yeah.
There are not as many mutual fund unique PANs in India. There are not as many unique Demat account holders in India as we have downloads of just one particular betting gambling app, right? So, do you think there's a rampant, I won't say rampant, but do you think there's a very alarming need for the government to intervene and start, imparting financial literacy right from the grassroots, that is from schools? Because, despite the GST norms also coming in, which have made winning absolutely impractical, now on these platforms, you have barely any chance of winning. Still people are, investing in these platforms with the hope of investing in get-rich-quick schemes, get-rich overnight schemes. And it's pretty alarming as per me. What do you have to say on that?
Interesting question. So I think the challenge is that you're talking of human behavior. So individuals have this, I guess, a behavioral bias, right? What's happening in the case of betting or gambling or speculative activities or opportunities is that the mind makes you feel that the probability of winning or gain is more than let's say the probability of loss or losing, right? And that's what kind of actually drives you to experiment and test out. And that's the things we have to really work against. You have to work against that behavioral bias. So absolutely, I think education will certainly help to make aware of the actually to see how the equation gets reversed in the investor's mind. That they're seeing a higher gain versus a loss. By making them more aware, you can actually change that equation in their mind. So it tempers that behavioral bias to move towards these kind of avenues. And like you said, increasing the cost of transactions itself is a kind of a gatekeeping mechanism to mitigate it. But yeah, your question about should you start that earlier on, that to me is a more general actually initiative one should anyway take. That you need to have financial literacy coming in much earlier from school itself amongst everybody, because that's actually it's a crucial part of your entire life journey going forward. That goes without saying, and that element of within that of what you're saying of understanding how gambling can be a negative impact definitely should be there.
So now the AUM of the mutual fund industry as a whole has grown to more than 70 lakh crores right now.
Right.
Now even 0.01% of it goes to the investor education awareness initiatives is a lot. It's a big amount.
Correct.
Do you think until the changes that happen from the grassroots, which require regulatory and government intervention, what can the mutual fund industry in itself work on to educate people right from the grassroots, from not just in tier 1, tier 2 cities, but from the rural areas as well?
So if you see what the industry has done from AMFI perspective, they really reached out, they spent their money fairly well to reach out to the entire, investor base in the country through the mutual fund Sahi Hai campaign, using mass media and using celebrities to also make sure that the message goes home very clearly, right? Apart from that, they also, which is the mass media channels, they're also doing a lot of grassroots activities, what I'm aware of. I can't enlist the entire things, but I do know that there's a very active involvement in having, for example, even the AMCs do a whole range of investor awareness programs on the ground, reaching out to investors across the entire country. Numbers aren't there with me right now, but it's fairly extensive, and every month it's an ongoing activity, right? And AMFI also has a bunch of programs they do to reach out to investors, also to schools. So that's an ongoing activity. Now, what you don't see is, because I think on the ground the impact, because it's micro, it takes time to build up. That's certainly happening, but you also have to have the mass media coverage, because that's clearly reaches far higher, it's immediate, and the visual impact is far more to get the awareness in your mind.
Got it.
But I think the industry done a pretty good job, and the whole concept of keeping money aside is a brilliant suggestion, and it's regulatory, so we have to actually spend that money in a certain specific way and manner, which is regulated and checked by the regulator as well. I think it's a great initiative to actually take this, message across the board.
So there's a burgeoning interest, and there's a fancy term coined for it, which is FIRE, financially independent, retire early, where people spend all of their time in investing and saving for the future, so that they can basically retire before their destined age of 60, which is typically the retirement age today, say at an age of 40, 45, and then they never have to work for meeting their daily expenses, and they can consume their corpus until retirement.
Right.
Given that markets are so volatile, and talking of FIRE as a concept in itself, first of all, do you think it is an interesting strategy that tier 1 individuals, high income earners should work on in the first place? And second, considering a lot of this money is going to be invested in, say, maybe fixed income products or say equity products also, and in a 40-45 year time period of cycle, we are also going to see a lot of ups and downs, including shutdowns of markets, if at all, God forbid, we have to go into any kind of war, right? And if there are any global exigencies, which will come, like, it happens in every 100 years, and we haven't seen anything happening that bad happening in the last 100 years. So first of all, talking of the concept, first of all, do you find it right from a mental health perspective and practicability perspective? And second is asset allocation in these time periods. Is it practical that this is something that India can follow going forward? Because US did see that happening in the last 30-40 years.
So to me, FIRE is a mindset. Okay, so to be able to keep money aside and invest it with the intent to be able to be financially independent, retiring early is a choice. Right, so I believe that if you have the financial independence, at the back of your mind, you can actually then enjoy your current job or choose the job that you like to do. So retiring early is a matter of choice, right? I'll park that. So conceptually, it's a great idea to be, right? And whether you are following FIRE or not, as a matter of anybody's financial planning for life goals and retirement goals, retirement has to be part of your critical life goals, right? That's one underlying statement I would like to make. Second is that yes, there will be volatility in the markets, which is why you would need to go to an advisor to plan out the retirement goal, right? And it depends on how much time you have for that. So the earlier you are, the equity obviously is a great way to start that process, because over time equity has higher returns, beats inflation, etc. And mutual funds can be used at the end to build a corpus and have a SWP to withdraw on a regular basis to kind of fund your lifestyle at that point in time. The key thing is that obviously there can be events that might derail this, but if you then come closer to your retirement date, how you allocate is important. How much goes into equity, debt, and safer investments, safer avenues, right? So two parts to it. How do you build the corpus over time? And then as you come closer to your target date, how do you manage it to make it more secure and more safer? So that's part of the planning process. Yeah, if like you're retiring and there's a war in that sense, that we have to wait it out. But all of us know that you see the entire history of the world, the last 100 years, there have been like a couple of world wars, but yeah, it's taken some time, but eventually it's the markets have picked back up again, right? So the current principles of FIRE and the current principles of financial planning and asset allocation, I think have kind of worked out the best way of doing this. Now, will people always be able to build the corpus that can help them, let's say, be financially independent and retire early? Depends on their income streams and how well they manage, how they invest. But that's anyway what all of us are here for in terms of the mutual fund teams and the advisors and the distributors and partners to guide people in that journey.
But do you think it is practical for, like, you don't have to work for the next 45 years, and even if, like, from a mental health perspective, that can someone sit at home for 5 years, and if they at all want to come back to the workforce, they are not well equipped in terms of their skill set to be able to be worthy of joining a workforce again? Because I'm sure, like, seeing this trend from 5 years from now, anyone who's not using AI will be at a backseat, right? I don't know whether they'll be asked to leave or not, but definitely they won't get as much increments as someone who's using AI will get, right? So do you think it is practical from that sense?
If you're asking me that after you retire, how do you, let's say, retire at say 55, right?
Right.
And your life expectancy is say 85. So 30 years, how do you spend your time? Right. Absolutely. So people have to have a very clear plan of post-retirement of what you will do at that point in time, because the mind has to be active. So to my mind, like I said, you can be financially independent. Retiring is a choice. Now you might continue in your current job if you love it. For example, in my case, I'm in the space, I love to be in the space of investment management. And technically, if Warren Buffett could be doing it till 1990s, it's a space I want to be in. Whether I retire now or later, to me, I'm not retiring ever from investments and investment management. Beyond that, you need to have, therefore, also your own personal interests or passions that you want to pursue. So you're right. I mean, you need to have a very clear post-retirement shift in what will keep you occupied and what will give you a sense of purpose and have meaning for you, and that's definitely important. So my advice would be that absolutely, maybe the need for money is constraining you from doing what you want to do, and once you're financially independent, you'll have the freedom of choice to do what gives you a sense of purpose and meaning. So that you have to prepare for and actually work towards that actually. So when you retire, you move into that seamlessly.
Any closing notes that you have for our audience and BFSI industry participants?
No, I would say it's a great time and great place to be in, specifically the asset management industry and business. The key thing, the way we see it, is all of us have a sense of purpose, because fundamentally through the wealth creation route, you are changing people's lives.
Right.
So that is the inherent purpose that all of us are here in this business for, and which drives us, to my mind, day in, day out. Because we have the investors' money, it's a fiduciary responsibility, and our intent is to change people's lives at the individual level, and therefore, for a lifetime. Keep that in mind.
So thank you so much, Kartik. Thank you so much for your time. It was a pleasure speaking to you.
Pleasure.
So the 3 key takeaways from our conversation with Kartik Jain, who's the CEO of Shriram AMC, are that first of all, the company has not been, very actively involved in their AMC business for the last 30 years, but especially in the last 2 years, their AUM has grown from close to 300 crores in January 23 when Kartik joined to 1,000 crores now. Now they are on a blitz scaling model where they have also raised external capital from financial services arm of South Africa, that is Sanlam. Second is that they are building heavily on data. They are not just relying on quant models like Python, but they are also giving a flavor of fundamental analysis in their strategies. And third is that Kartik believes mutual funds have a very significant role in shaping the lives of individuals in terms of meeting their financial goals. And Shriram AMC 2.0 is here to stay. Thank you so much for watching this episode. Do let us know in the comments as to what your thoughts are about this episode. See you in the next episode.